Dick, good to have you with us. You're a fixed income guru, and what I want to get your theory on inflation. Most normal folk think that the Federal Reserve is against inflation. Ben Bernanke surprised people when he said we like 2% inflation, but you think it's even worse than that.
Well, thank you for having me, Steve. And the answer is yes. The fact of the matter is that when you look at the kind of problems that we have, the budgetary problems, and the ability of the government to cope with that magnitude of problem, it looks like inflation is going to become one of the tools that they use to remedy the situation. We've always thought of inflation as a consequence of bad policy, but I'm contending that inflation is going to become the policy in effect. And Bernanke's announcement of the 2% is a way of saying, well, you know, it's a safeguard and it's better than deflation. But I think that the real target is probably more in the 5% range, and typically you overshoot so you can get up as high as 8% before real policy moves set in. But if you think about it, 5 to 8% inflation over 10 years would remedy a heck of a lot of problems that we have today. Creates a lot of new ones, of course, but politicians are only or principally focused on those short-term problems, and those are the ones that would be alleviated quickest by inflation.
They have a theory called the Phillips curve, which says you need a little bit of inflation to get economic growth. Experience shows that's nonsense, but they still adhere to this theory. You'd have thought the 1970s would have gotten rid of it with stagflation. But what leads you to believe they're going beyond the 2%, that in their heart of hearts they really want 5 or 8?
Well, because 2% really doesn't do much to solve the problems. And I think that the problems are so pervasive across a multiple of things, that the magnitude of the debt, the trade balance, the indexing of various cost components, which the government can modulate by the fact that it controls CPI, which is another whole topic of how that's being manipulated. So in a way, it gives the government a tool that they can use where nobody has to hold a hand up or be held accountable.
On the CPI, let's chat for that for a moment before we go back to QE2. You say how they concoct the thing understates inflation, and therefore people don't really realize, even though they go to the supermarket or the gas pump and see prices are rising, that it's worse than what the official numbers indicate.
Well, that's it. The CPI
hedonic, you call it?
Yeah, the CPI is first of all, they take the two biggest components out of there, food costs and energy, and say, well, that's too variable. It shouldn't be in there. It shouldn't be in there. Which
core inflation.
Yeah. So we've got a core inflation. Now you get into that, and you have what they call hedonic adjustments, where you get a $20 increase in the price of a cell phone, and they say, oh no, that's really a $20 decrease in the price of the cell phone because it does so many more things than the old phones used to do, and consequently they can basically delay the recognition of the true underlying inflation for months and months, and that of course has huge impact on things like that are indexed to inflation, which is everything from tips to government salaries, pensions, Social Security, and even some of the Medicaid.
Now on QE2, we all thought that was a device to goose the economy. You think it's part of the Fed effort to bail out the banks. Can you explain?
Well, after 2008, the banking industry was obviously in dire straits. They were terribly undercapitalized because of all the mortgage write-offs they had, and the Fed basically opted to give them an out rather than having to go dilute their capital tremendously by issuing new shares. They went and created this artificially low short-term borrowing rate of 25 basis points. And with long treasuries being about 4.5% at that time, a bank was able to with leverage, basically earn over 4% rate of return, risk-free in U.S. treasuries. But of course, you can play that game, but the risk there is that if interest rates start to move up, you need to get out fast if you're leveraged. And in last November, Bernanke in effect said that, inflation is coming, and without saying that he was going to that they should be getting out of the carry trade, he was in effect saying we're going to make $600 billion available to the economy for buying treasuries, which was a way of saying we're going to deflate this carry trade bubble, so don't everybody rush to the door here at the same time. And we see that policy seems to be working pretty well. Rates have not gone up significantly since the initial round of this, where a few too many people did step up, so we saw some uptick in the rates. But effectively, he is deflating that carry trade bubble. But of course, at the expense of buying back these treasuries at prices that were going to look pretty expensive in about 6 months after the program's over.
But even so, if given the fact that banks have leverage, if the long bond goes from 3.5 to 4.5 or 4 3/4, that's a huge loss, isn't it?
It would be if they were still in that position, but the Fed has basically held the yield now at a steady rate, and is taking back those treasuries at those price levels, so that they've locked in. You think about it, they've earned over 4% leverage 10 times, so they've earned 40% for about 2 years. That's a heck of a nice return. But there was another benefit to them of doing this, in that for 2 years the banks have been really occupied with resolving all the mortgage problems that they had on their books, and they didn't have a labor force to really do that. And so effectively, by the banks employing all their assets in treasuries, they freed all their loan officers as a workforce to straighten out the mortgages on their books. And this is why the banks weren't lending during that time period.
How much of the non-bank lending is attributable to the fact that examiners were going to give you a hard time if you made a business loan, which was not the same thing as buying treasuries?
Well, that was one of those things that it really, I guess, sort of became a cover story, if you will, for the fact that the banks weren't interested in lending to the private sector as long as they could make 4% risk-free.
And in terms of QE2, it expires in June. What is going to happen to the 10-year and the 30-year bond then?
They're going to go up. They'll be rising. How quickly it depends on how quickly the banks get back to lending out that money, because the velocity of money now is going to start increasing as the banks lend this money out, and we can expect that those long rates, which right now being still managed by the Fed, will seek market levels, and that's going to be higher.
What, 6%, 8% yields?
Not this year. No, I think you may see that next year, but I think it'll go up 1 or 2% this year, and I think that from there it's anybody's guess.
And so would you advise investors of the stomach for it to short treasuries?
Well, that's difficult for most people to do. What I have been advising is for people to basically, between now and the end of June, to basically get out of all of the fixed rate type securities that they have in terms of bonds, munis, and such, and go into more things that are more tied to the stock market, because that's going to be able to adjust more rapidly. So we've been saying buy blue chip, high dividend stocks.
Let's get into those, but I just want to hammer this home. If you have fixed income securities, now's the time to get out? I mean, fixed rate securities.
Yeah, especially junk bonds and such, because it's that below investment grade category that's going to get hit the hardest. It has come down to levels that we haven't seen in a long time in terms of the spreads between treasuries and these junk bonds. And I think that once rates turn around, they're going to take the biggest adjustment.
And but even treasuries, if you have a 10-year, 30-year treasury, you'd say get out because you're going to take a principal loss, at least on paper.
It would not be a category. I think that the capital losses that you stand to have in the next 2 years are way more than the interest you're going to be able to earn on those securities. So yes.
Now, one of the things you seem to like is floating rate securities. How would an individual get into those?
There are any number of floating rate securities that are outside the bond market. Typically, most of them are in the bond market, but they're difficult to buy there. But there are a number of packaged products on the New York Stock Exchange, mostly issued by banks, J.P. Morgan, Citibank, Goldman Sachs.
These are $25
These are
preferreds?
these $25 preferreds that really are backed by a bond that is tied to the CPI or to LIBOR for the most part.
And you also, as you mentioned, stocks. An environment like
Yes,
this.
I know it's it's a heresy for me, but to talk about stock and buying stocks. But the Canadian energy stocks have always been favorites of ours because they are high dividend paying. But even blue chip securities like an AT&T pay 4 or 5% yield. As long as they're not paying out more than 75% of their cash flow, and they have a good history of dividends, they're good options because they will adjust for inflation much more readily than a fixed income security.
What other names would you throw out? You mentioned AT&T.
AT&T, Pitney Bowes. There's a lot of funds also that we recommend, closed-end funds that specialize in these kind of securities, and they for example, there are what we call buy right funds, which are funds that hold a basket of blue chip securities, and then they write call options against it. And from that, they can basically get an enhanced return, so that some of these are paying 7, 8, 9% payout rates.
In terms of those preferreds, say the name of your newsletter that you do with us, so people will get in a commercial here. In terms of finding the names
it's a
of
Forbes
those,
Lehmann
folks.
Income Security Investor newsletter.
And in that you have these $25 preferreds with floating rates.
We mentioned those, and we also run 4 model portfolios to give people a sampling of a starting point if they want to follow our philosophy there, and it gives it in terms of low, medium, and high risk, so they can pick their category as well as a blended one.